$50 trillion. That's how big ESG investing is projected to get by the end of 2025. But here's the catch. What if the very scores driving this money are flawed? What if companies with the best ESG ratings are actually polluting more, not less? The numbers are staggering. Nearly 80% of real environmental data is missing. And in those gaps, a hidden bias, quantitative greenwashing. A new kind of systemic distortion. And no one's talking about it. In this episode, we unpack a groundbreaking academic paper that could change how you think about sustainable investing. Forever. Listen now, and stay till the end, because the real story behind ESG might not be what you think.
Today, we're diving headfirst into something huge in global finance, ESG investing.
Absolutely huge.
I mean, just listen to these numbers. $41 trillion in ESG stuff back at the start of 2022.
Yeah, and projected to hit, what, $50 trillion by 2025?
Exactly. That's like a third of all global assets under management, one out of every $3.
It looks like this, massive force for good.
Yeah.
The idea is channeling all that money towards sustainability, tackling global challenges.
On the surface, yeah. Powerful stuff. But here's where we pivot. Are those ESG scores, the ones guiding all this money, are they actually reliable?
That's the critical question, isn't it? What if, despite the good intentions, these scores aren't really capturing what they claim to capture?
What if that $41 trillion, maybe soon $50 trillion, isn't actually going to the most sustainable companies? What if it's being kind of misled?
Misled by a hidden bias, perhaps, in the very scores designed to guide it.
That's the core tension we're peeling back today. We're basing this deep dive on a really crucial new paper. It's called ESG Data Imputation and Greenwashing by Julia Crippa from Princeton.
A very insightful piece of work.
We're going to unpack the hidden complexities in ESG data and break down what it all means for you, whether you're investing, running a business, or just, interested in how finance is shaping our world.
Our goal here is really to give you a solid understanding of this huge issue of missing ESG data. It's a big one.
Yeah, how it kind of warps the scores.
Exactly. And we'll introduce this new way of thinking about greenwashing, quantitative greenwashing. It goes beyond just, misleading marketing claims.
Okay. This should shed some serious light on why current ESG ratings often seem to fall short, and maybe what needs to change.
Precisely. For them to actually deliver on that promise.
All right, let's get into it. First stop. This idea that ESG has a kind of dual meaning. Laura Starks highlighted this in her AFA presidential address in 2023. It's not as simple as it looks.
No, not at all. She talked about values investing versus value investing. They sound similar, but the implications are quite different.
Explain that difference for us. Values versus value.
Sure. So values investing is about investing for reasons beyond just profit. Maybe promoting sustainability, aligning with your personal ethics, making a positive impact. The non-financial goals are key.
Right. Doing good for its own sake.
Pretty much.
Yeah.
Whereas value investing, in this context, is more about using ESG factors to spot financial risks or opportunities. The main goal is still financial gain, but you're using ESG insights to get there.
So for some, ESG is an input, like a filter for risk.
Exactly. And for others, it's more like an output, a societal goal they want their investment to achieve.
And this isn't just academic talk, right? The actual rating providers, they see it differently too.
Oh, absolutely. It's fundamental. Look at MSCI. They're quite clear. Their ratings aim to measure a company's management of financially relevant ESG risks and opportunities. It's about the bottom line impact.
Financially relevant, okay.
But then you take Moody's. Their approach is different. They talk about the impact on multiple stakeholders. They want to enable better, more sustainable decisions. That sounds broader than just financial relevance, doesn't it?
It definitely does. More holistic, maybe?
We could say that. And what research by Berg, Colbell, and Rigobon showed back in 2022 is that these different approaches, these different philosophies, lead to ESG scores that often don't agree. Significant divergence.
So as an investor, picking MSCI versus Moody's could give you a totally different picture of the same company's ESG standing?
Completely different conclusions, potentially. It's like, using different compasses in a fog, as you said.
But here's the kicker, right? Even if those compasses were somehow aligned, they're working with incomplete maps.
That's the perfect analogy, which brings us straight to the elephant in the room.
Yeah.
The missing data problem in ESG.
The data black hole.
Exactly. See, there's no single global rulebook for how companies have to report sustainability stuff.
No universal standard yet.
Right. So companies have a lot of leeway in what they choose to disclose. And the result? The paper calls them extremely sparse feature matrices. Basically, data sets full of holes, like Swiss cheese.
And sparse isn't just a little bit missing, the number is shocking.
It really is. The paper states about 50% of the overall ESG dataset is incomplete.
50%. Half the information is just not there.
Gone. And what's worse, other research, like Sahin and colleagues in 2022, found this weird negative correlation.
Meaning,
the less information a company discloses, the higher its ESG score tends to be.
wait, that's totally backwards. So being less transparent can actually make you look better on ESG?
That's what the data suggests. It's deeply counterintuitive. And when rating agencies hit these gaps, they have to fill them in somehow. It's called imputation.
Okay, imputation. Making educated guesses.
Essentially, yes. Take Refinitive's approach for CO2 emissions, for example. If the actual number is missing, they first look at the company's past emissions.
Makes sense.
If that's not there, they look at past energy use. Still nothing. Then they just use the median CO2 emissions for that company's whole sector.
Ah, the sector average. That sounds logical as a fallback, but the paper says it's not efficient. Why not?
Well, because ESG is supposed to be about what makes a specific company stand out. Right. Its unique efforts, its non-financial differences compared to peers.
Right. It's singularity, as the paper puts it.
Exactly. Using a broad sector median just washes all that away. It makes the scores tend to correlate more with just the sector and the size of the company rather than its actual individual sustainability performance.
So different ways of filling the gaps lead to different scores again.
Divergent and incomparable ratings, yes. Which leads us to this really novel idea in the paper.
Quantitative greenwashing. This sounds different from what we usually think of as greenwashing.
It is quite different. We know about, qualitative greenwashing, misleading ads, selective reporting, stuff researchers like Lane or Bazilier and Vaudet looked at, false claims.
Right, the marketing spin.
This is different. The paper defines quantitative greenwashing as a bias that creeps in when rating agencies don't efficiently impute those missing metrics.
So it's not necessarily the company lying.
No, it's about how the agencies fill the gaps. It's a bias baked into the data handling process itself, potentially distorting the score even without any intent from the company.
A systemic issue in the scoring itself. Wow. Why does that distinction matter so much?
It matters hugely because it means ESG scores can carry this inherent quantitative bias, this distortion that market players, investors, companies really need to understand and account for.
So a high score might not just reflect good performance.
It might also reflect how the agency handled the missing data for that specific company. Your investment aimed at impact might not be hitting the mark you think it is.
That is genuinely unsettling. But, okay, the paper doesn't just point fingers. It proposes a solution, right? A three-step approach.
Yes, which is constructive. First step, imputation. They use a much more sophisticated method than just sector averages. It's based on work by Shang and Pelger on large dimensional latent factor modeling.
Okay, what does that mean in simpler terms?
It means it looks at patterns across many companies and over time. It uses both cross-sectional and time series information to make much more accurate estimates for the missing data points. It harnesses way more information.
Smarter gap filling. Got it. Step 2.
Step 2, ESG score prediction. They take this newly imputed, more complete data set and use machine learning to predict what the ESG scores should look like based on this better data foundation.
Okay, predicting a truer score, perhaps. And final step?
Step 3, greenwashing quantification. This is where they measure it. They basically calculate the difference between the scores predicted from the better data and the actual scores provided by the rating agencies.
Yeah.
That difference is the quantitative greenwashing.
A precise, objective measure of that bias. Very clever. So using this new lens, what do they find about how ESG scores are actually performing? Any big surprises?
Well, first, it reinforces what others, like Burke and Binsbergen in 2021, have found. The way ESG works right now, it's just not set up to deliver real-world impact in the way many people hope.
Okay, so the impact piece is weak. What else?
Here's a huge one. The promises versus performance trap. They found the metrics that most strongly drive ESG scores are things like promises, targets, and incentives.
So company policies, setting goals, that kind of thing.
Exactly. Stuff that signals intent. And guess what?
Yeah.
Less than 20% of that kind of data is missing. Companies are pretty good at telling you what they plan to do.
Okay. But what about the data on what they actually did? The realized variable?
That's the flip side. Nearly 80% of those realized variables Actual emissions, actual water use, actual waste generated are missing.
80%. So the scores are heavily weighted towards promises because that's the data they have.
Precisely. It means ESG scores, as currently calculated, reward companies for making strong commitments, even if there's very little data to show they actually followed through.
It's like grading a student on their ambitious study plan, not their test results, because most of the tests are missing.
That's a great analogy. And it lines up with what Bams and Croft found in 2022. Those promises often don't translate into actual improved performance, even years later.
Wow. Okay, that leads directly to what the paper calls the emissions paradox, right? Which sounds bad.
It is pretty jarring for anyone focused on climate.
Yeah.
The paper gives examples finding that some companies with high ESG scores actually show increasing emissions over time.
Increasing
Yeah.
while having a high score.
Yes. And conversely, some companies with low ESG scores show decreasing emissions.
So investing in high ESG doesn't automatically mean you're backing lower emissions. It could be the opposite.
It directly challenges that assumption. And it confirms that finding from Bams and Croft about a positive correlation sometimes seen between emission levels and ESG scores.
A green investor trying to lower their carbon footprint could actually end up funding companies making it worse if they just follow the scores.
That's the potential risk, yes.
Yeah.
It gets complicated.
And it's not just emissions, right? There's this disconnect between the overall ESG score and the specific environmental score, too.
Right. The paper looks at environmental risk, defined as how much the overall ESG score deviates from the specific E-pillar score. On average, they found a deviation of 15.5 points.
15 points difference. That seems significant.
It can be. It leads to what they call misleading investments companies with a high overall score but a surprisingly weak E-score. Or lost opportunities, companies with a low overall score but actually a strong E-score.
So if you care specifically about the environment, the overall score could point you in the wrong direction.
It might only partially hedge that specific environmental risk. You could miss good companies or back weaker ones environmentally.
Okay, this is painting a pretty concerning picture of current scores. But the imputation method they propose, that's a positive development.
Absolutely. The paper shows their imputation methodology is significantly more accurate. It corrects for those biases towards sector and size that plague traditional scores.
Meaning a company's individual actions matter more.
Yes. It suggests that a company's singularity, its unique profile and performance, is more important than just lumping it in with its sector average. That's a crucial finding.
And this holds up across different data providers.
Yes, they tested on both Refinitiv and MSCI data. Despite the differences in what those databases cover and how they structure things, the methodology and the core findings were consistent. Robustness is key.
Okay, so this quantitative greenwashing, this bias from filling gaps, where is it happening most? Which sectors are the hotbeds?
The really striking finding here is that quantitative greenwashing mainly affects technology companies.
Technology? Really, I might have guessed energy or industrials. Why tech?
Followed by energy and consumer non-cyclicals? Yes. But tech was number one. The least affected were healthcare, real estate, and utilities.
So why tech? We often think of them as cleaner, maybe more data savvy.
It seems to come down to disclosure patterns. The paper finds that tech companies tend to disclose less ESG information overall, especially those binary yes-no type variables.
The promise metrics we talked about, like, do you have this policy?
Exactly. Those binary promise metrics are often very important for how ESG scores are calculated. Since tech companies disclose less of this specific data, the rating agencies have to predict or impute more of it for them.
And those predictions, those imputations, are where the quantitative greenwashing creeps in, inflating the scores unintentionally.
That appears to be the mechanism. It's a disclosure gap, creating an estimation bias, rather than, say, deliberate misrepresentation by the companies. It results in this kind of artificial halo effect.
So less data leads to more guessing, and the guessing tends to skew positive for tech in the current models. What if you adjust for how much data is missing, like weighted greenwashing?
That's interesting, too. When they looked at weighted quantitative greenwashing, technology still leads, but the effect is less concentrated. Its share drops from nearly 70% of affected firms down to about 43%.
Okay, still number one, but less dominant.
Right. And other sectors like consumer cyclicals, industrials, and basic materials become more prominent in that weighted view.
Suggesting it's not just the amount of missing data.
Exactly. It suggests other things matter too, maybe sector-specific reporting norms, company size within the sector, Other factors play a role in how vulnerable a sector is to this bias. It's complex.
Okay, so bringing this all together, the implications here are pretty major for everyone involved. Let's start with researchers. What's the message for them?
The big takeaway for researchers is always question the legitimacy of ESG scores. Especially if you're studying impact investing, don't take them at face value.
Dig deeper, use the raw data.
Yes, using the underlying raw metrics, combined with efficient imputation methods like the one proposed, is vital. Current scores might not be a reliable proxy for genuine sustainability. It requires more rigor.
And for the rating agencies themselves, this paper feels like a direct challenge.
It is. It's a strong call for higher transparency and robustness in their methodologies.
Mm-hmm.
The fact that different methods and data gaps create these incomparable and potentially biased ratings is a real problem.
They need to get better at filling the gaps.
They need to prioritize efficient, consistent, and transparent imputation techniques. That seems paramount.
Okay, now for investors listening, people who genuinely want to invest responsibly, what does this mean for you?
It means you need appropriate expertise, either yourself or through advisors you trust. Relying solely on the headline ESG score isn't enough. It's just not reliable enough on its own yet.
You have to look under the hood.
You absolutely do. Combine the scores with analysis of the raw metrics, understand how missing data might be influencing things. You need a more complete evaluation. Don't just trust the score blindly.
And what about for companies, both those trying hard on sustainability and maybe those just managing their scores?
Well, for companies, this research can actually help them understand which metrics really drive their score, say, on Refinitiv.
Yeah.
That allows them to focus their efforts.
But there's a warning, too.
Yes, a crucial warning. If the market relies only on these potentially biased ESG scores, capital could flow to companies that look good on paper due to imputation rather than those making genuine progress. It could reward perception over reality.
Misdirecting well. Okay, final piece. Regulators. They seem critical here.
They are the key players, according to the paper. We desperately need universal standards for sustainability reporting. That's the foundation needed to reduce greenwashing, both qualitative and this quantitative kind.
Like we have for financial accounting.
Exactly. Think about credit ratings. Multiple agencies, sure, but they work off a common framework and publicly available data. We need that for ESG.
Is there progress happening there?
There is. The International Sustainability Standards Board, the ISSB, released its first standards, IFRS S1 and S2, which came into effect in January 2024. That's a huge foundational step toward getting reliable, comparable sustainability disclosures globally.
So steps in the right direction, finally. Okay, let's try to wrap this up. This has been, well, a really eye-opening deep dive.
It certainly challenges some common assumptions.
Yeah. We've seen ESG investing is massive, the intentions are good, but it's seriously hampered by these huge data gaps.
And by the way, those gaps are filled the imputation methods.
Leading to this quantitative greenwashing, a bias that rewards promises more than performance, and might actually steer money away from truly sustainable outcomes.
It highlights a systemic issue in the current setup, not just a few bad actors trying to game the system. The system itself has flaws.
Flaws that can mislead even careful, well-meaning investors. Real impact needs a much clearer picture than we currently have.
That's the bottom line.
So here's the final thought for you, our listener. Knowing now that a company's ESG score might tell you more about its promises and how its missing data got filled in than about its actual environmental or social impact, what will you prioritize?
When you make your next investment decision, will you dig deeper? Will you ask those harder questions about the data behind the score?
Will you demand more transparency, more verification? Something to think about.
Definitely. We always encourage you. Keep questioning, keep learning. Always dig beneath the surface.
True understanding is always a deep dive away. Until next time, stay curious.
You made it to the end, so you now know the truth behind the ESG illusion. How missing data and weak standards are distorting the scores. How quantitative greenwashing quietly inflates ESG ratings. And why promises outweigh performance in today's ESG system. You're now ahead of 99% of investors still trusting the scores at face value. That's powerful. But here's what's next. Share this episode with someone who cares about sustainable investing, like if this changed how you think. Subscribe to catch next week's deep dive, because we ask the questions others won't. Liked how that paper got decoded? We've spent 20+ years turning machine learning and AI into real-world tools, not just slide decks. Whether you want to implement a model, validate research, or build something from scratch, we can help. Explore our showcases to see it in action. Visit our site or contact us directly. Let's turn complex ideas into working intelligence together.